friends. Welcome back to the Wall Street Skinny. I'm Jen.
I'm Kristen.
And we are two lifelong friends, former investment bankers, and teachers here to give you the skinny on how to land and thrive in the world's highest paying jobs. So today we are incredibly lucky to be joined by Dan Nathan, CNBC Fast Money superstar, and also the other half of our favorite duo with Guy Adami from On the Tape, OK Computer, and Market Call. And Dan is an expert on the equity markets. He's an expert on Pearl Jam. And though he denies it, he is an expert on options trading. He's got 3 decades of experience in the markets, and he's going to give us insight into the evolution of the equities trading business on both the sell side and the buy side. He's going to give us insider secrets of what it's like being a pundit talking about the markets on TV every day, which is no easy feat. And he's also going to give us a crash course in options. Now, full disclosure, okay, we begged Dan. We were like, hey, can you please give us like a super nerdy deep dive into delta and vega and gamma and theta? And he was like, absolutely not. You are going to have people's eyes rolling back in their head and they're going to be so bored. We're going to have way more fun. And he was 100% right. But if you're just here to learn, you are definitely going to get a great introduction to the absolute basics of equity options trading. Dan explains it beautifully. So you're really in for a treat there. And the last thing that we're going to get into is how AI, in Dan's view, is going to impact equities trading. Again, both on the buy side and on the sell side. And Kristen and I got a little preview yesterday of what the AI future is going to be like. We announced, actually today, that we are launching our first self-paced course this fall. And as we were getting the email set up to roll out to our subscribers, Kristen got this random email out of the blue saying, big announcement. We are making squiggles your way with the sexy tagline, learn to make the sickest squiggles in the world with our new tutorials. Okay, spoiler alert. We are not teaching you how to make squiggles, but rather launching a self-paced course in everything you need to know to learn a job in investment banking and private equity, okay? And thank God that this email only went out to you, Kristen.
Well, we had a panic. Yeah, we were
oh my God.
Yeah.
I would have died. But also, if this is Skynet becoming self-aware, like, I think we're fine. Like,
well, but it wasn't even just this. We've also, ManyChat, which we use on Instagram, because Instagram, you can't like add links to posts, which is, I don't know why they do that. I think they don't want you to click out of the app, but
yeah,
they have this they do have the ability that you can use this like extra add-in that of course costs money, where people can like, if they comment something, then we will send you the link so you can actually get it in your DM. We use that because we get so many people messaging us all the time. It's way easier to be like, here, just do the thing. And like, if you want it, you get it. If you don't. But it's now starting to send people things on posts that we have not set it up for. And it's sending things like, here, do you want this freebie that we used to have that we no longer have? And it's like, here. But wait, no, it's going to go to a dead link. Like, what are you doing? Stop. And I don't know what to do because there's like so many automations. I don't know how to deal with. I don't know how to like fix it. So the computer and technology shit, it's a scary, brave new world. The freaking AI has already taken over and I don't know how to stop it.
Well, my favorite thing is when someone comments like, you need a facelift, and it sends them a DM like, would you like to listen to our podcast on Spotify, YouTube,
Someone
or
literally
Apple?
commented. We had a video, I think it was like my vest video, where there was no ManyChat set up because it wasn't relevant for anything. And someone said something and it sent a link, and that's what you like to listen to the podcast. The guy goes, well, that's forward. And I was like, oh my God, I am so embarrassed that we're sending like poor people that don't want to do anything. They just want to be like, I like the vest, like.
Yeah, the whole point is for people not to be spammed. And it's making us accidental spammers. We're not trying to spam you, we promise. And on the flip side, there's all these controls in place with these email subscription networks to prevent spamming. But it's like, okay, click this link to sign up. Someone clicks it. It's like, enter your email. They enter their email. Then it's like, great, we sent you another email asking if you still want to subscribe. And people are like, okay, where, how? And if you like miss that, then it's like, oh, well clearly they didn't want to subscribe.
We're getting so many messages from people too who are saying, I signed up for the newsletter, I'm not getting it. Can you check? We're getting a lot of those messages. So guys, bear with us with the technology.
If we check, like, I don't know how to check. I'm sorry. Yeah, so we suck at technology. I mean, AI needs to replace us in this function, but it needs to replace us effectively, and it's making our lives more difficult, which is exactly what I said all along. But anyways, so we're so excited to talk to Dan here. And Dan is actually going to be, we're going to see him in person, I think, at the iConnections conference in January as well. So that's going to be a lot of fun too. So we'll have a little reunion there. But anything else, Kristen, before we dive right in?
I think I told you I'm going to New York tomorrow, so that'll be fun. I'm doing like a solo trip, going up for the day and then coming back. So
for a bachelorette party.
It's not actually a bachelorette party. It's a bachelorette dinner. My sister-in-law is getting married in September.
That's so civilized. That sounds actually really nice.
Yeah. I mean, so we're doing drinks and then dinner in Flatiron. So going back to kind of like my old hood. And you know where I'm staying, Jen.
Oh, nice.
Our favorite hotel.
Our
spot, yeah. And then next week I get to hang out with you. So it'll be a blast. So we have a lot going on in the next couple of months. So looking forward to it.
We do. Awesome. Well, let's bring Dan on and we'll get right into it with our options talk.
Awesome. All right, so we are here today with a very special guest. So we have Dan Nathan. And for those of you who don't know him, Dan is the co-founder of Risk Reversal Media. He is a CNBC Fast Money anchor, and he is a podcast host, or I should say co-host, of On the Tape, OK Computer, and Market Call. He has 28 years of experience in finance, and he got his start as a equity long-short trader, later moves into options. And so I think it would be helpful if you can walk us through just like how you got into finance to begin with.
First things first, ladies, it's great to be on your pod. I know we did this kind of home and home podcast with Guy Dami and you guys in our studio. I know that you guys had a great conversation with Guy, my co-founder here. So I am delighted to be on your pod here. It feels like I'm on this. Have you guys heard of this podcast, Bingetopia? My daughter, the 21-year-old, it's two women and they're putting their brains together and they're having fun. And she is just obsessed with this pod. So go check it out. And they came from nowhere, like you guys, like they're like, let's turn the mics on. Let's have some fun. Let's like kind of educate folks into some of the things that interest us. So, I feel like I'm on the Bingetopia for adults. How's that?
Love it. I'll take it.
All right. So my career, I started in the late 90s at a fund called SAC Capital. This is now called Point 72. I was hired to be an equity long short trader. I was probably like 24 years old. I was always interested in the markets. When I was undergrad in school, I had two jobs that were really formative for me. I had one that was 2 summers in a row after my freshman, sophomore year. I worked at a bond brokerage firm in Toronto. And that's really what got me kind of interested in the whole vibe of really, sales and trading. And you guys know, and I know you guys do such a great job on your pods, but also on your social feeds about really kind of dissecting what the different jobs are within finance. And that's one of the things that I realized. I realized it as somebody who was a young person wanting to get in the field a long time ago, but all the people that I talk to who are currently in school and want to get into finance, and I'm saying that with air quotes if you're listening to it, most people just don't even know what that means. There's like 100 different jobs in finance. And so I tell people, I'm telling them every day, listen to Wall Street Skinny because they are breaking it all down. Okay. So I got into the business from a couple internships. I also worked for a stockbroker for 2 years in college. So I got interested in the stock market. I got interested in institutional sort of trading. And so after like a year and a half as a consultant, I went back to the trading world. I got this great opportunity at SAC Capital, working with some amazing, long short equity people. And at the time, we didn't know it at the time, but it was a full on stock market bubble, right? This is when, Yahoo went public and Amazon went public and, the list goes on and on and on. And these stocks were just careening higher, you know what I mean? Every day. And some folks were saying, well, this is a bubble, but people forget the S&P from the moment that, Fed Chair Greenspan in late 1996 called the stock market, I guess it was trading with irrational exuberance. Yes, he averaged 30% a year for the next 4 years. Like, just think about that, right? So when people talk about identifying a bubble and saying it's about to burst, it can always go much longer than anyone thinks it should. So I did that in the late 90s, and it was great. I went over to London and started a long short equity group for a hedge fund over there. The guy who actually helped me get my job in 1997 came over with me, and we were partners in doing that. We did that for a couple years, and I came back and worked with the guys I was working with. So, a few different hedge funds over a 10-year period. I got into options. I was doing prop trading at Merrill Lynch in their equity derivatives group. And so that was from 2007. And so, that was my kind of institutional career. The last 10 years or so, I've been kind of trading on my own and doing a lot of stuff in the media. So in a nutshell, started out like a lot of folks did back then in a kind of active trading role, learned a couple different products along the way, and then find myself talking a lot more about markets than trading these days.
Oh my gosh. I'm like actually so excited because we have not had anyone who has that background that has actually worked in this sort of derivative space, in the equity long short space. And so this is actually very exciting. But before we go on, I do want to ask you, did anyone ever call it SAC?
Yes, it was definitely SAC Capital for a while. Yeah. Well,
all right.
Yeah.
Jen and I had a back and forth in one of our earlier episodes because I called it SAC and she gave me so much shit for it. She's like, nobody calls it SAC. And I was like, yes, they do.
Well,
so anyway,
the kids today, and I know that you guys engage with a lot of 20 somethings, right?
Yeah.
Do they even know, like he was a legend. This is
no, they don't know who Steve Cohen is.
Yeah, we should.
They probably know him as the owner of the Mets.
Right. And that's where I was going to get to, which is kind of interesting. They know him as the owner of the Mets, but he's a billionaire who made all this money in the hedge fund space. You know what I mean? And now his hedge fund is like 33 billion under management, which is, obviously nothing to shake a stick at. But I find that kind of interesting. I mean, he was a legend, in the 90s, in the 2000s, ran into, a few problems in managing, I guess his portfolio managers paid a $1.4 billion fine. Think about that without admitting any like wrongdoing or not. And then he's back at it, raising billions of dollars a few years later after turning into a family office. So pretty interesting stuff.
The kids today, if you will, they don't know the big household names from when we all started in the industry. They don't really know who Alan Howard or Paul Tudor Jones or George Soros were in their original incarnations, right? Julian Robertson, they probably don't really know, but they know Tiger Cub. They're like, oh, it's a Tiger Cub. But it's the next generation of geniuses and capital raisers and all that fun stuff.
Yeah, but think about it. So when I came into the industry in the late 90s, I mean, that's the way everything worked. Entertainment, sports, politics, you know what I mean? You were your own brand at that time. And so when I think about it now, and specifically in finance, I mean, it's so automated, right? When you think about it, it's like a lot of these masters of the universe as related to, finance and investing, they are spending millions and millions of dollars getting into systematic trading. You know what I mean? Like hundreds of millions of dollars. So at the end of the day, some of the biggest rock stars within those organizations are the guys programming the machines. Back in the day, it used to be like the guys, and largely guys, with all the bravado, thinking that they had a bigger edge than the next guy. And they were basically trying to get access to resources and capital and all that sort of stuff. And now that's just gone. It's just like math. It's just returns. And you know what I mean? And so I find that really interesting. I still have a lot of friends from that kind of late 90s, early 2000 era. And there's some firms that are still doing a lot of the PM driven stuff that's not as quant based. But the whole idea of like qualitative sort of stock picking, I mean, it's kind of like out the window in my opinion.
Yeah. Well, actually, I'm curious because you said that you started at SAC, and when you were working as a equity long short trader, were you doing any of the fundamental analysis? Because it does seem that so much of the time nowadays, usually it's like you have to have the 2-year investment banking experience, and then you go in and you're doing a very robust valuation or fundamental analysis. But then there's also more of like technical analysis. And so I'm curious, when you started, how were you analyzing the stocks that you were either buying or shorting?
So that's a great point. And to be very clear, for the first year and a half, I got my balls blown in every day by the guy I worked for. And so I basically had a few screens in front of me. I had 2 phones on my shoulder. One went to the New York Stock Exchange. The other went to the Chicago Mercantile Exchange. So we basically were trading stocks on the machines and actually through, the NYSE. We had floor brokers down there. And then we were trading index futures with the CME with a broker on the floor there. And so basically all day long, from basically 9 o'clock when the futures really started trading to when the stock market started opening at 9:30 until about, 4:30 or so, market obviously closes at 4 o'clock, it's just being barked orders that nonstop. That's what I did for a year and a half. But then the guy that I worked for gave me the opportunity. He was very much a momentum trader. He did not focus a lot on fundamentals. And so the opportunity that I had was trying to figure out what YHOO or AMZN or some of the AOL, what some of these tickers that were like moving all over the place and largely to the upside, what they did, and then kind of getting an information arbitrage. And back in the late 90s, they did not have Reg FD. So this regulations that came in about information that could be shared with investors from companies. And so it was still kind of the wild, wild west, though. Like insider trading was always specific rules about that, you know what I mean? But disclosures were something that was not as uniform back then. So the idea of getting information, whether it be from companies, whether it be from analysts who are covering it, whether it be from salespeople who are talking to other investors, right? And the thing, that was what was considered edge at the time, right? And then a lot of it was event driven. So for me, part of my role when I started getting capital allocated to me and being able to kind of put it to work was thinking about trading with a bit of a mosaic, right? So you have momentum. It is what it is. You probably have a market call. You think that the market's going higher. You want to try to find stocks that are going to go higher with the market, right? And then what are the reasons why it might go higher? So you look at some charts and you start doing pattern recognition as it relates to technical analysis. And then you start figuring out a little bit about valuation, comparative valuation, how an individual securities valuation, sits within the broader market's valuation, right? And so it kept on doing, stuff like that and kind of just putting more and more tools in my toolbox. And I'll just say one thing that was really interesting is one day in the firm I was at was up in Stamford, Connecticut. I lived in the city. And so it was about an hour drive there and back. And, one day I was driving home with a guy who's a great tech PM. And he had a stack of paper, again, this is 1998. You weren't emailing research reports to you, and he would print out just what he thought were like 10 of the most interesting research reports during the day. And he'd bring them home and he'd read them. And he said to me, can I give you any advice? He's like, read as much as you can get your hands on every day. And that's the only way to learn. So I started reading, fundamental research. I started learning how to do technical analysis, did a course on it from New York Institute of Finance. I started learning about valuation. And then the other part of it is just learning and failing and figuring out how to manage your risk, right? And so sitting in a room with a bunch of people doing it in all different ways, and everyone has their own way of kind of coming up with trade ideas and investing ideas and seeing what works for some people and doesn't for others. And a lot of times it comes down to their demeanor. Some people are just big risk takers in their lives generally, and that really kind of does, find its way into how they kind of manage their trading or their investing, that sort of thing, and vice versa. Some people are very risk adverse and they only put trades on when they think it has a very high probability of success. So for me, I was sitting in a great seat. I was sitting 10 feet away from a guy who ended up being a legend. And the one regret I have about it back then is I wish I knew a fraction of what I know now back then, because it would have been a lot more useful.
For someone who's interested in like getting up to speed and a lot of this stuff, are there any opportunities anymore to kind of have a similar experience to what you had, or is that like basically gone entirely?
Yeah, I don't know if there is professionally. I know a lot of these funds are hiring quants and programmers. And Guy and I had the opportunity. It was kind of interesting. I think it was about 2 years ago at a CME event. David Solomon, the CEO of Goldman, was there, and the two of us interviewed him. And it was really fascinating. I never even thought of this. He's like, half of our employees at Goldman Sachs are basically programmers. You know what I mean? And when I thought about that, I was like, wow, they have this entire apparatus that serves the institutional client base. GSAM is a massive, organization that manages assets for institutions, but also high net worth individuals and the like. And so just all the touch points, I think, for individual investors making qualitative decisions, they're just kind of getting fewer and fewer. And so when you think about as an individual, the days of having a stockbroker calling you and saying, hey, Kristen, hey, Jen, I got this great idea and you should, it just doesn't exist anymore. They're not, those folks are not even incentivized that way at all. They're incentivized to actually take your 1% management fee, don't screw up, don't basically underperform the broad markets or whatever. And that's it. And you know what? I think you guys know this as well as anybody. I mean, slow and steady wins the race, dollar cost average, the major indices, whether it be S&P 500, do it when it's going up in what you think is a bubble and do it when it's going down, when you think it's a bear market. And at the end of the day, if you look back 5, 10, 15, 30 years from now, that was going to be the way to play it. So some folks that over trade an investment portfolio, it just creates huge drags on long-term performance. And I will say this is like one mistake that I've made routinely over the last, let's call it 25 years, is that my training professionally has hurt to some extent the way I think about time horizons and risk management for a longer term portfolio. And then the other thing I'll throw in there is punditry. I mean, doing a TV show most every day after the market closes and not being someone who just flip flops every day, that's what makes a great trader, especially a short-term trader, is being able to change your mind, to manage risk, to take profits when it's appropriate to do so, size positions appropriately. And if you take that mindset into long-term investing, it's a disaster. You know what I mean? Like, so what the original question was, are there opportunities for people to do that? I'd say, don't do it. You know what I mean? Go into something that has a transferable skill set as you progress in your profession, but that also might be helpful in your personal life.
Can you say more about why you think that it hurt you, though, in terms of why your actual experience hurt you now as a sort of longer term investor?
Well, there's two things I would say. The skill set that I learned in the late 90s and then really tried to perfect in the first half of the aughts, it's just not transferable anymore. There's not jobs that are doing that, to answer your question. So the idea of like scalping stocks is just not a thing anymore. You know, they used to have this thing called SOS trading, is small order execution services. And, you know, when I got out of college in 1995, they were hiring these groups, like droves and droves of really smart kids from great schools and the like. And they were putting them in front of machines. And they were teaching them little things, and they were just momentum trading. And they had really tight stops, you know what I mean, on the positioning. So they wouldn't let you lose a lot of money. They also made money out of transaction fees and interest charges. It was like, talk about the house, you know what I mean? Like winning every time. And so lots of folks did that. And then they realized once the internet bubble really started to burst in 2000, there was just no edge anymore. So those places kind of went away. So then the idea of like an SAC that was giving individual traders, let's say 10, 20, $30 million in the late 90s, as they got bigger and bigger, that was not a model that was sustainable. They couldn't have PMs and groups that, you know, a PM, and then they were probably had a couple traders, and then they probably had 5 different analysts. They had to manage hundreds of millions of dollars, right? To like get a return on that, and they lever it up. So the idea of having self-directed sort of traders just choosing what they wanted to trade and making their own decisions, it just went away. You know, there was just no place for it. And a lot of the folks on the buy side who were at hedge funds back then, they actually moved to the sell side. They moved to become position traders at Merrill or Goldman or, you know, whatever, you know what I mean? That sort of thing. And so a lot of those jobs just went away. And a lot of the folks that I came up with, they're just not in the business. I don't know what the hell they're doing, but they're not in the business.
So basically, if you want to be a trader, it's like learn how to code and learn how to be a programmer.
To some extent. I mean, and listen, I don't mean to be like there's no future in that. Think about what Guy and Danny and some of the folks who are contributing to our podcast do. I mean, there's a lot of people who still like to look at short-term opportunities in the market. They look at events, they look at product announcements, they look at momentum. There's a whole host of other things that they like to do. But oftentimes I'll say to somebody who's a 20-year-old kid in college, I'll be like, you really have to think out 5, 10 years. Where is technology going? What do you think this seat that you really want, that is so coveted right now, where do you think it's going to be in 5, 10, 20 years, that sort of thing? Because if it's not a skill set that you think you can build on, you know what I mean, then it's not a great career path right now. And I've also been telling people a lot, young people, is like, if I'm you, and let's say I take that job, maybe as a sales trader, investment bank, or it's maybe it's a position trader, or maybe it's some sort of thing on the buy side, is like, I would be thinking about how generative AI is going to disrupt this business, because we're not going to really see the main disruptions, not in this year or next year or whatever. It's going to be 5 years out, and it's going to be the most sophisticated folks with the most resources who are going to be able to implement it the best. And then if you can start thinking about how it's going to change different industries, and I'm not one of these folks who thinks it's just going to be like flip the switch and it's going to be lights out and Skynet's going to be, you know, killing us all and all that sort of stuff. And by the way, if we get to AGI and the machines take over, they're coming for your Bitcoin first. Think about that, right? Like that stuff is gone. All right. So just think about that. So, my point is about that is like, I have no idea what's going to happen. I think back to the late 90s when there's so many folks saying there is no end in sight for the valuations of Amazon or Yahoo or Excite or Lycos or AOL or this or whatever, because it's going to change every industry that you know of. Well,
Yeah.
that happened, but it took about 20 years for it to happen. You know what I mean?
Mhm.
And it wasn't before the asset bubble absolutely got crushed. I mean, people don't realize that Amazon, from its highs in 2000s to its lows in 2002, lost 85% of its value. You know what I mean? And the same thing for a whole host of other names. So history, rhymes if it doesn't repeat. And I don't think it's going to be too different this time from an investment standpoint. But I also feel like it's going to change every industry that we know about, but it's probably going to do it later than most folks think.
I hope so. I mean, I will say, I think that one of the things that's kind of scary is that not only do we not know where this whole thing is going, but again, to your point, the pace. And I mean, there's like the extreme end where it's basically like all jobs will be gone. Like no one's going to have any jobs anymore because literally every single thing will be replaced, unless maybe if you're a plumber or a nurse. And even then, I mean, like robotics is coming for that also. So I do think we're kind of at this point where for basically anyone, it's this uncertainty of not only what's going to happen with generative AI, but also what the time horizon is. Because that's the biggest thing, I think, with what happened with the tech bubble and with the internet, is at least it took 20 years, I think, because people expect it to be more compressed. Even if it's 5 years, that's still like no time. And so to like retrain people, where by the way, you might not even need to be retrained because there's potentially no jobs. I mean, I'm a little bit in like the doomer side of things, but I don't know. Jen, I'm not on the Jen side where basically she's like, it's all going to destroy us and the Terminator is coming.
Yeah.
Well, I will say, Dan, you've been a pioneer, in fact, in content similar to ours with incorporating AI in terms of how we listen to the news and how we get that communicated, especially on the market side. Can you talk a little bit about Market Matrix?
Yeah, so we started this a few months ago, and part of it is like I was getting to know this company called Perplexity, and I met the CEO, and he came on our podcast, and he came on Fast Money, and I like to be an early adopter, like no matter what it is. And last week I read a Bloomberg article about these G1 smart glasses, and you know what? I pre-ordered them. I want to see what's going on. Like I didn't do that with the Vision Pro from Apple because I could have just guessed right there and then this is going to be a dead bang loser. And at some point it's going to be kind of interesting, but it's not going to be from a productivity standpoint. But these G1 glasses looked really interesting to me. So I like to kind of figure out what's coming next, And so Market Matrix, I saw that Perplexity was doing a daily tech pod, and it was basically AI generated. And what Perplexity is, it's a wrapper for Chat GPT or for, these large language models like Claude and a few other, and you pay $20 a month for it. And it looks just like the others from a user interface, but you can choose which models that you want, right? So I saw what Perplexity was doing. I was like, well, we should do this for markets. And so what Guy and our team do is we take what we think are 10 of the most important business and market headlines. We put them in Perplexity. We give it a prompt to summarize it in 30, 45 seconds. We take that text and then we put it into a voice bot, an AI voice bot. And then our team puts it into a short little podcast of under 10 minutes and we kind of bang it out there. And I just think that's really cool. Guy was on board. He's like, listen, I don't know if this is going to turn into, Skynet and that sort of thing. I mean, he's really worried about all that stuff. No, he's not as much of a doomer. But like, it's just fun for us. And the other thing is think about it this way. It's leverage for us, right? So every podcast we do, Guy and I and our team, we have to be situated. We have to have great guests like you guys. We have to have original content. It has to be kind of interesting and fun and all that sort of stuff. We have to take time to promote it and push it out in the world. This thing is just a much less of a lift, but we just think it's as impactful in a different way than some of our, self-directed content, if that makes some sense.
Yep.
Yeah. I will say, I do think it's so funny. When Jen and I first started our podcast, we were all excited and we spoke to the CEO of Gimlet, who sold his business to Spotify for some insane amount of money. And he, in the beginning, because Jen and I were like very nervous, so we scripted everything. So we like scripted literally like the conversations with each other. So we go back, we listen, we're like, this is super cringe. But he listened and he's like, it doesn't sound as organic as you think it does. He's like, what people are listening for is they're listening for the companionship. And so I feel like the good news for people who have podcasts is that, especially with you and Guy, you guys have just such this amazing dynamic that I feel like people are still going to always go to you guys because they want to hear what you guys have to say and they want to hear the interactions with you. But I do think you're entirely right that, I mean, to be able to then leverage AI. So it's like one more thing. Yeah. It's a little bit of a hedge, but I also feel like the good news is like it's in your workflow so that it's not I mean, the thing has taken off and you're like, oh, wait, how does this ChatGPT thing work? You're already kind of using it and kind of growing with it. So I think that's actually genius. Jen, you should take notes.
It's interesting what you said about like, the vibe or the chemistry that Guy and I have. I mean, we've been doing Fast Money together since 2011. That Guy is the original Fast Money guy from going back to 2006. He's the last one standing from the host and the other four panelists. And so for me, it's been really fun doing Fast Money all these years. But when we came up with the idea to kind of start doing long form pods, for me, it was just like right in my wheelhouse. We get to do it the way we want to do it. We don't have to be overproduced. To your point, you guys can go wherever you want with it. But what's different about, let's say, Fast Money is that every night we have to comment on something that is maybe breaking right in front of us, right? A company is reporting earnings and we have to do like very quick analysis. So I'm looking down at my computer on my FactSet, and I'm like trying to figure some stuff out. People have very high expectations of that, and they should, but they don't understand the complexity and the kind of difficulty of doing that. And unless you are in markets, unless you are an active market participant, you will never know how difficult that is. And then, you have to hear from all these people and you will be wrong. I mean, that's the point. I'm sure you guys have had plenty of traders and PMs that have been on your show over the last year or so that telling you some of the best traders only win 52% of the time. But it's
if you're at 52, you are crushing it. Oh my God.
But think about this. As a pundit, you're held to a much higher standard. And so for us, the idea of being able to turn the mics on, turn the cameras on, have a little fun with it, talk through our process a little bit, we just find it a lot more interesting. Some of the feedback we've gotten, and very different than you guys. I mean, you guys obviously have fun, but you guys have a mission. You are educating people on a daily basis. I send your podcast, I think I just said this before, to so many kids that are in college right now who want to learn about finance. And then it's not just yours. There's tons of really good resources on the internet. And
no, it's just ours.
No, but I mean, listen, you guys wouldn't exist if there was other stuff that was better and other stuff that was worse. You guys saw an opportunity to sort of do this in a very approachable way. And I think that's what's most important. I think hopefully that's what Guy and I and Danny and the rest of our crew are accomplishing.
One of the things that you and Guy had commented on when we were on your show was that kind of in every duo, there's a different energy, right? And there's a meme that has made the rounds on social media about how in every friend group, there's the golden retriever and the black cat. And it's funny because I actually think in our day-to-day life, Kristen is the golden retriever and I'm the black cat. But I think a lot of people think it's the opposite, that she's more inscrutable. We've always joked how, Dan, you and Kristen have a very similar energy, and Guy and I tend to come across more as the golden retrievers. But I'm curious.
Well, anytime Guy texts us, he's like, "Oh, Kristen's just ignoring me," because I just never actually see when people text us. So I'm like, "Oh, okay, sorry, keep going, Jen."
But I'm curious. It's one thing to be a trader and to take positions and to have convictions privately, and for you to be the person who knows when you're right or wrong and have your P&L reflect that. It's another thing to do that on a very public stage, and to talk about your convictions in the markets and trades that you like and don't like. How did you get comfortable with that on a personal level, going from the very real stakes of P&L to the very different stakes of doing this in the public arena and having people judge you on a multitude of levels, not just, hey, did he get the call right or not? But like, do I like him? Does he present this well? Does he communicate well? Do I feel a connection with him?
Yeah. Well, this is a funny story. So about 10 years ago, a really good friend of mine who was a producer of Fast Money and Options Action, a guy named Max Myers, who actually found me in 2008 to start doing the show Options Action in 2009. And he's been a great friend ever since. And he called me up one day and he said, I got some good news and I got some bad news. You want to hear first? And he's like, I was like, whatever, I don't give a shit. And then he was like, well, we just did this, like, these focus groups and like Q ratings or something like that.
Uh-huh.
And he's like, okay, the bad news is that people just don't like you that much. The good news is that you're not in the middle. And he said like that. So he's basically said that for any sort of, programming like this, you need to have people that are really well liked and some people that are not. And so I actually go back to
it's like things. How they cast the Real Housewives. You always have to have a villain.
Totally. And like, think about like professional wrestling. They always have like the sort of heel. And I'll tell you how that came about for me. So when I was in the business, CNBC was always on in the background, but
Right.
there was no audio, right? And, people would look up and like, why are those tremolis up there talking about the markets? They don't know what the hell they're talking about. If they did, they'd be sitting here on the desk. I mean, like, really,
Yeah.
that was kind of the mindset. And so for me, I came into it with a little bit of that mindset. And then the other aspect of it is like, okay, so then I started doing the show and I thought, and this is why Guy and I just really vibed really well. It maybe took a year or so, is like, man, 90% of the folks that come on financial media, and I don't just mean CNBC, they're just cheerleaders for the stock market. I mean, that's all they do. If you think about what their incentives are. Now, granted, the stock market goes up 85% of the time. That makes a lot of sense. But here's the deal. The way I learned trading and investing is like, if you're going to buy a security, because you have a bullish view on it, you better know what the bear case is. You better know why it could go wrong, right? And so some folks, they love an idea. They think that, whatever, they're going to make this product, they're going to put it out, it's going to, be really profitable, better margins than, and it should be trading at a higher multiple. That's great. But like, what happens when the product is a dud, you know what I mean? And the stock starts going lower. That's when they still believe, you know what I mean? And then they get stuck with something that maybe started out as a trade and turned into a really bad investment. You know what I mean? So for me, I kind of wanted to go on and start picking apart what I thought was a universal, bullish thesis. And I thought that's how I could be helpful to a CNBC viewer who wasn't trained the way I was or you guys were, you know what I mean? And so because I took that sort of view, people didn't like it because they want to actually feel good about the things that they're buying. You know what I mean? They don't want to hear the bear case. And, so that's kind of how I became the heel. I don't really give a shit. I mean, like, as far as I'm concerned, I'm doing what I'm doing. If I stop enjoying it, I'll stop doing it. You know what I mean? But I really enjoy the group that we have, nights that I'm on with Melissa, Guy, Tim, and Karen. It's probably one of the more fun hours of my day. And hopefully it's not entertainment. Hopefully we're really trying to help people and educate them. And whether we're right or wrong, I don't mean that that's not important, but we're held to a very high standard.
Yeah, I mean, I don't think people realize, obviously Jen and I do a little bit because we edit our podcast and it's like, okay, here's all these filler words. I mean, we were commenting to each other how you guys like don't use filler words. I mean, when you talk, it is so clean. It is relative to how most people talk. You guys, again, you think on your feet so quickly, and the dynamic you guys have is it's almost like you are like mind readers. Jen and I need to kind of get a little more in sync with that because it'll just be like one of you asks a question and then how did the other one know to ask the next question? It was so seamless. I mean, I do think it's one of those things that it's like a learned skill.
Well,
And
it's reps. It's like anything, and we're very fortunate that we've been doing this together. Now, the podcasting for 4 years, we've really evolved the programming. Guy and I always knew we could do it blindfolded with one arm tied behind our back, and in person is much easier. You can read people's, sort of.
That's true.
That is true.
You know what I mean?
Yeah.
Like, and so when you guys were in the studio with us, I mean, that was actually just such a fluid conversation. You guys have great chemistry, and so, it was kind of like you guys on one side, us on the other. And it was really fun. We got to do it again when you guys are in New York. But again, to be too predictable is not great TV either. And I just want to say one last thing on this is like some folks, if they want to be really critical of people who are just real time trying to process market news and giving, off the cuff sort of, and I don't call it advice. I would never call it advice. I would just kind of describe the way I see something, but it's certainly not entertainment. And if anyone tells you it's entertaining, it can be entertaining. That's very different. People that are very dry, you won't get people coming back to you. So it has to feel like a conversation that you want to be a part of or drop into, you know what I mean? But it should not start with entertainment because then you're just not going to be particularly credible, in my opinion, because you can only be so funny so much of the time.
Yep.
Well, speaking of the proper educational element, that brings me right to what we had hoped to pick your brain on a little bit. So you talked about how you formulate oftentimes your theses, whether it be picking apart a trade that everybody else likes and thinking about the bear case, or simply what's the best vehicle for expression. If you're bullish on the stock market, what do you do? Right. And you talked about your experience a little bit here. You touched on it as an options expert. I would love it if you could walk us through kind of the 10,000 foot view of why do people trade options in the first place?
Right. I don't call myself an options expert, by the way.
But you are.
No, you know what's funny? I've been approached probably, I don't know, 10 times over the last 15 years since I started doing options action in 2009. And because of my pedigree as being at a couple, brand name hedge funds and then at a large derivatives group, at a large bank, that sort of thing. And predominantly because then I started doing TV. So if you're a book publisher, you love getting someone to write a book who has a very easy outlet, you know what I mean,
Oh,
to
yeah.
promote it. And so I used to say to these guys, like, I'm still reading options books. You know what I mean? Like, I was not your traditional, I didn't start learning about options until I was 10 years into my career. And I had this really interesting experience, I think in the late, maybe early 2000s, when my partner and I just started like littering our long short equity book with like calls and puts and this and that, whatever. And, we had this risk manager would come down to us and say, ask us about our Greeks and how it fit, you know what I mean? This and whatever. And we're like, what? And so, we were just being total dummies. And so it wasn't until like 5 years later when I had this prop trading opportunity within a derivatives group. And I literally had to take courses on options. I had to read books on options. I had to take tests on options. And, for me, it's also like reps, right? Like kind of getting to know what the intricacies of trading. But let's go to like what your listener or your viewer might be really interested in. I always thought of options as something, at least for retail investors or like, let's say a prosumer, as a very aspirational product. So you start out and you start trading stocks, but you're generally buying stocks because most retail investors don't short stocks, right? But let's just say you're long Microsoft because you think it's going to go up for X, Y, and Z reasons. But then you realize as a user, as an investor, you're like, Adobe should go down off of this. Well, most people are not going to short Adobe, you're right? You know what I mean? But you might say, oh, what can I do? What's a put option? Put option gives me the right to sell an underlying security at a certain price at a certain point in time. And then if you buy it, you can define your risk to do it. And so someone's like, oh, I want to learn about that. That sounds kind of cool. I'm pretty much a long only investor, but every once in a while I come up with an idea that I think the stock is going to go down or whatever. So learning about options to kind of define your risk, I think is really important. So to me, I think there's three main uses. Okay. So let's just say you go back to that investor who's long Microsoft and they're never going to sell it. It's going to be, their kid's college fund or something like that. Right. And so the idea is like, oh, well, Microsoft pays a 2% dividend. That's not so much on an annual basis, but they buy back a lot of stock and the earnings are going up every year. And like, this is a company that generates a lot of cash and, they dominate their industry. I'm just going to always stay long this. This is like a 20-year hold. Well, maybe because you know that it's going to be like that, maybe every 2 months you look for an out of the money call, okay, to sell and take in that premium. Okay. So if a put gives you the right to sell a stock at a certain point in time, a call gives you the right to buy a stock at a certain point in time. Now that could be any sort of underlying, it could be an ETF, it could be some other instruments, as you guys know. Okay. So what happens if if you sell a call, okay, which is a bullish bet of buying a call, you're selling it, you basically have the opportunity to take in the premium of that call if the stock or the underlying closes below that strike price. So think about this. This is kind of the gateway trade to options investing. You own Microsoft, you look out 2 months, you sell a call, you take in that premium if the stock is below that call strike, and then you're making like what some people would call a synthetic dividend, right? And you do that routinely every 2 months, whatever the heck it is, that's really great for your return. So the other one I would say is like defining your risk. So using leverage. Let's say I'm long Microsoft and because it's appreciated, the stock, I'm kind of like at a really big concentration within my investment portfolio, you know what I mean? But the stock has come off a little bit and I know they're going to report earnings in a week and I know that they're going to have this user conference in 2 weeks. And I say to myself, the stock just sold off of the market. I think their earnings are going to be really good. The technicals look pretty good. The valuation looks cheap for the first time in a while. I want to lever up into these two catalysts over the next month or so, right? And I might buy a call. And if I'm buying a call on top of the stock that I own, I'm defining my risk to the premium that I pay for that call. Does that make sense, right? I know you guys know this, right?
No, but you're explaining it very well.
Right. So it'd be yield enhancement would be the first one. It'd be leverage and defined risk. And then the other one I would just say is all out risk management. Okay. So let's just say in the case of Microsoft again, right? You own this stock, it's had a huge run up. And then let's say you come to the conclusion that you think, expectations are way too high. The valuation has gotten really high. The technicals look really stretched, no matter you use relative strength or any host of other technical indicators, that sort of thing, right? And so you say to yourself, well, I want to own this forever, but I'm really nervous that the stock's gone up 50% in 7 months, you know what I mean? And maybe you buy a put, right, to protect your downside. And what are you doing there? Let's say the stock is trading at $100 and you buy the 95 put and you pay $2 for that. And so you are protected the strike less the premium that you pay below that, $93, right? So you're defining your risk to the downside of $7, right, into this event at a certain period of time. So that's risk management. Now, I think the idea of buying puts against your individual positions or portfolio all the time, that could be a huge drag on earnings. Because what do you want to do when you buy protection? You want it to go worthless. You want the underlying security that you own, in that case, the stock, to go higher. And so if you keep buying puts, against long positions, it's going to drag your portfolio. And then there's other strategies, right? Like, you guys know, a risk reversal. That's the name of our company. Well, let's just say you want to collar, okay, like an individual position. Let's say Microsoft, again, is trading at $100. Let's say it was $60 7 months ago. And let's say you think that the broad market is getting a little extended. You think tech shares are overvalued. You think that, we're going to election season and maybe, things could be a bit rocky for companies that could be squarely in the, sights of regulators, whatever the hell it is, right? And let's say you say, all right, I like the idea of taking in premium by selling a call against my Microsoft. Let's say you sell the 110 call out a few months for $2, okay? And then let's say, well, I really want to protect my downside too, and I buy a downside put. So I use the $2 that I sold the call out of the money, and then I use the $2 to buy an out of the money put. And let's say the 90 put costs $2. Now I have a zero cost collar on right now. I own the stock, much lower, but let's say mark to market at $100. Between now and the expiration, I could have profits up to that short call strike at 110. All right. And then obviously I could lose money to the downside, but I bought that 90 put. So I'm protected down to there. So that's a great use for risk management purposes. So those are the three main uses that I talk about with a lot of self-directed investors. And, listen, and you guys know this, is like professionals, they're looking at a whole different other vol strategies. And those are the things for me as a long short trader, when I joined this equity derivatives group, that's the stuff I had to learn. That was not particularly intuitive to me, because I was usually buying something because I wanted to go up, and I was selling something because I wanted it to go down, or I thought it was going to go down.
You were taking expressions on the underlying asset itself, not on, whatever it is, right? Skew, things like that.
Yeah. So skew is a term that, when I did options action for 10 years, if I uttered that term, the producer's like, stop. You know what I mean? Like, you know what I mean? Like,
you can say it here. This is a safe
I know.
space.
We wanted to ask you about some of the Greeks, and you were like, I can't talk about that because people's eyes will glaze over, even though people actually do care. So,
well, all right. So let me tell you two things that I think are most important, right? Like to me, there's two Greeks. Okay. So delta. For every dollar that the underlying moves, whatever that delta is, and again, it's math, there's a calculation there. You know what I mean? Like, the option should change in value for every dollar. So that's a really important thing to know, right? So some people they'll buy a call and the stock will go up a certain percent, and then the call's not gaining value. And as time is decreasing, like, there's all these different inputs to the pricing of options, right? As you guys know. And so those are the frustrations that a lot of people who are just buying calls or buying puts that they have. And then the other one, this is really important, is theta. Basically, how much an option over time is going to lose value. Okay. And I know some of you guys are eyes glazing over. We're going to make this fun again. I promise you. You know what I mean? So those are really interesting things that I think most people have to understand if they're buying options, or they're selling options for that matter. If you're selling a call against long stock, that sort of thing. So to me, that's really important. The point about skew, I think this is a great lesson for most investors who want to figure out the sentiment towards a stock. And I'll give you an example. Okay. So in the case I just gave you with Microsoft, it's trading at $100. And let's say I'm looking out 2 months. September expiration's a month away. October expiration's 2 months away, right? And let's just say I think the stock is going to be range bound, but I'm nervous that we have another move like we had on August 5th, where big tech stocks just careen lower. And I'm not going to be able to put my finger on it, but I think 2 months, I want to get a little protection, but I don't think the stock's going to rocket to the upside, right? So I sell the 110 call, I use the proceeds to buy the 90 put, and I'm collared. But here's the thing. In that instance, I'm giving you a situation where there is no skew between the out of the money call and the out of the money put, right? They're the same cost. And that seems like it would make some sense unless there was more fear of the stock going lower. And usually there's skew to the downside because people are willing to pay up for protection, right? And so when I think about what was going on as NVIDIA has been skipping higher, it's up 150% of the year. I think it was up 100+% of the year last year. The skew was to the calls, which is not something that you see too frequently, right? So the skews, so that the 10% out of the money call was trading much more expensive than the 10% out of the money put, which tells you how much demand there was for NVIDIA because people were buying it any which way they could. They were buying stocks. They were buying ETFs that were heavily weighted to it. They were buying calls, you know what I mean? And so that was creating a lot of skew to the calls. And that just showed you what the sort of, demand for that security was. And so to me, that's how I kind of use options like to kind of figure out also sentiment. Here's one other thing. So on CNBC or in our pods, people want to know what we think about a stock into an event. Earnings, take it to the bank. Every 4 quarters, a company that's listed on the NASDAQ or the NYC, they report earnings. And what do? Basically report results for the last 3 months. And then most of them give guidance about the current quarter that they're in, which is really the next 3-month period. And so investors are basically looking at how a company did relative to what they said they were going to do last quarter, right? And then you start thinking about like what expectations are, you know what I mean, for into the print. Now you could look at things like skew, but you could also look at an at the money straddle. What is that? That's a call premium plus the put premium. Okay, so let's use the example of Microsoft again. It's trading at $100. And let's just say they're reporting Thursday after the close and it's Monday. And if I were basically to say, I take that out the money straddle on the Friday, so 5 days, okay? Expires Friday on the close, but they're reporting Thursday night again. Let's just say the call would cost me $2 and the put would cost me $2. I put that together, I have $4 in premium. If I were to buy the straddle, let's say I did not have a strong view about which direction the stock was going to go, but I thought it was going to move because I thought they're either going to beat big or they're going to miss big or something like that. And I think it's going to move. If I bought the straddle, so it's buying premium, it's buying the vol that's built into this trade, I would need the stock to get above 104 by Friday's expiration or below 96 by Friday's expiration to make money. I'm indifferent to the direction. Okay. Now that seems like a really weird way to trade, right? Like, you know what I mean? But let's just say I just use the at the money straddle to give me a sense of what market makers, the folks that make markets and these options, okay, how much risk they think is into that event, right? So let's just say I take that $4 in premium for the straddle. Okay, so that's a 4% implied move into the earnings event, right, over a 5-day period. And let's say I go back and I look and I say, well, Microsoft on average over the last 8 quarters has only moved about 2%. And the largest move it's ever had was 4% or something like that. Okay. Then I might come to, this conclusion that the 4% implied move for Microsoft's earnings in a few days is just way too expensive. You know what I mean? Now, I might not trade off of that, but it might give me a sense for the sort of sentiment that's around the stock into this event. And so that's a term that we use all the time, implied move. And that's the back of the envelope way to kind of figure that out. Take the at the money straddle, divide it by the strike. And that over that period of time is what the expected movement is for that underlying security.
This is so cool. I didn't actually know any of this stuff. So I'm like, this is very educational for me. I will say, I do think that in general, and I don't know if you agree with this, but I think that for many people, the way that equities trade is relatively intuitive. I think that fixed income is a little bit less intuitive. I think options are arguably even less just because there's so many moving parts. I mean, how did you get up the curve with this intuition? Like, how would you suggest to someone to actually like learn the intuition here?
All right. So great. Couple things there. to get hired on a derivatives desk now to an investment bank or to, a hedge fund or something like that, you have to be like some math whiz coming out of MIT. The idea of taking some lax bro from UPenn, like me in 1997, it's gone. It's over. It's not
Still
happening
happens,
ever.
Dan.
Unless your mom or
Fixed income.
dad runs the firm, you know what I mean? Like it's not happening. Okay. So, and I'm sorry to burst anyone's bubble there. Right. And so how do you figure it out, on your own? One thing I would say is that Fidelity or even like a Robinhood. Okay. Like when I say even a Robinhood, I mean, because, most folks think it's geared towards a certain demographic. Right. And I think a lot of people have a preconceived idea because of, all the YOLOing and meme stocks and crypto trading and that sort of thing.
Wall Street bets.
Yeah. And they're really expanding their offering. I've gotten to know those people pretty well. And a lot of them come from places like TD Ameritrade and the like. And then Fidelity, on the flip side of that, they deal with a much different clientele. But ironically, both those firms want to move into each other's kind of backyards a little bit. And so both of those sorts of companies, and you could throw TD and Schwab and some of the other ones in there, they have lots of really good educational resources, right? So they don't want you to trade options unless you've done a bunch of things. You have to put in a separate application when you're opening a brokerage firm to get approved to trade options. And then it might mean going through some of their training modules and the stuff like that. Not different than when you guys started, on Wall Street back in the day. Then they give you the opportunity to paper trade, doing that within their system, because right now options have gotten really confusing. When I started trading options, there were basically expiration was the third Friday of every month.
What are these 0-day expiry things? Can you talk about the huge emergence of that? Do those even exist in fixed income?
Well, I don't know if they do, but the one thing I'd say is so it used to be that you had, once a month, and then you had quarterly options, and then you had what they call leaps, like 2 years out, that sort of thing. Those were the only expirations. So then I want to say 10 years ago, or maybe a little longer, they started doing weekly expirations. Then they started doing, to your point, daily expirations. And so 0 days to expiration, that's what they call them, ODTE, they've blown up, because if someone wants to make a low premium bet about the direction, of the underlying, a lot of them trade in the SPY, the ETF that tracks the S&P 500, but there's also a whole host of others. You just don't have to put up a lot of money to make that bet. Now, a lot of folks, institutions, algos, they're selling those options, right? Because they know that most options expire worthless. And that's why when you ask me if people should just go start trading options, I already told you the example of me in 2000 and 2001. I thought I was somewhat sophisticated. I was doing stupid things with options. So to learn about them, I think you want to be smart and just stick to those kind of 3 buckets that we talked about, you know what I mean? Before you start buying butterflies and selling condors and all those sorts of things, because that is for such a small group of market participants, you know what I mean? So, I'd say there's plenty of resources on the web. There's some really good books, the books are really boring. They're like kind of textbooks, but nowadays there's lots of good stuff on YouTube. And the other thing I'd say is, and you guys know this, is if you're going to listen to somebody on the web, just check out what sort of real engagement they get. You know what I mean? You guys have built a really great community. You can see the sort of engagement. You can see how you guys engage with people. You can see you guys on video and how do you engage? You guys have a level of humility that doesn't always exist on the internet. You know what I mean? You just told me, I have no idea how that trades. And most people come across, they want to sound like experts because that's what works on the net.
Yeah. I mean, but I feel like the world of Wall Street is it's so vast that I'm sorry, you can't be an expert in every single part of the industry. So I feel like, I don't know, you kind of have to say, hey, this is what I know. I know this well. You asked me about, for me, converts, anything to do with banking. I know my shit cold there, but I can tell you, I don't know half the stuff that Jen talks about fixed income. Now I do. Now I'm I'm not actually a pseudo expert, but I know enough to be dangerous. Options less, but I know enough of the very tiny little narrow thing. But I don't know. I think very few people know every single thing about every single thing, unless, I don't know, you're like Warren Buffett and you're also 95 years old. It takes time to build up that expertise.
Yeah. Listen, I've forgotten a lot of the stuff. And I don't mean I'm not trying to use
You've forgotten more than we'll ever know about options, Dan.
What I'm saying Thank you, Dan. What I'm saying is, there's a lot of things that I learned, 15 years ago, they're just not applicable to how I operate anymore. You know what I mean? I don't care about vol surfaces. You know what I mean? What I care about are things like skew. And so to me, so you asked about my process before. Okay, let's just say I read something in New York Times or Barron's or Bloomberg or whatever over the weekend. It's like, oh, I didn't really think about it that way, right? And then so like I come in and I'll kind of open my fact set and I'll pull up a couple things. I'll look at the valuation, I'll look at the comparative, and I'll read a few research reports on it. I'll go to their website and maybe like poke around and try to like figure out, what this product is and why it was so interesting to that writer. And then I'll go to YouTube and look at like some people reviewing the thing. You know what I mean? I'll just kind of mess around a little bit, and then I'll pull up the chart, and then I'll look at some other charts and, all this sort of stuff. And then I might say, okay, you know what I mean? Like, then I look at the options market. Then I kind of see what is the underlying implied volatility, the price of this option telling me about all those other inputs that, you know what I mean, that I was thinking about. And, rarely does one outweigh the other. I think of it as like a big mosaic, right? And then I might kind of say, all right, technicals is not anything I ever lead with. Okay. Like to me, it's a picture, and I think it's very useful. And I've been doing technicals since 1997. The first guy that I worked for, he gave me this, remember those big box computers, like a compact that were like,
Of course,
this big, and it had this like big box like behind it.
I learned to type. Yeah. That's what we learned to type on.
He gave me one of these with this. I can't remember what the program was. It was like some charting. It was like Quote Trek. And every night I had to plug in my landline to the computer and download that day's tick. Okay, so it was 1 year charts, but I had to download it unless you got it like download it and you had that like noise that the AOL used to make.
Yes.
And then I had to search. I had to hit next, and I had 3 patterns that I had to look for: long consolidations that might break out, long consolidations that might break down, and V reversal patterns. And the guy that I was working for was a momentum trader, and to him, those were the things that were most important. He didn't care about the company's earnings or the company, you know what I mean? That sort of thing. So when I think about like the inputs of why I might trade something or why I might buy something, options are not that important. A chart is not that important. Valuation is not that important. But if I can start tying a lot of those things together in and around like what I think the catalyst is for the stock to move one way or another, that's when I try to get conviction. And then the last piece, as we've been talking about, how can it go wrong? You know what I mean? Unless I have some reason to think like what could go wrong, then I don't know how to risk manage the position.
Yeah.
Yep. I am curious, because we were talking about AI earlier, and I listened to, and I need to stop. I'm a broken record with this podcast, but there's a podcast called Acquired, and they did this whole thing, a deep dive onto Rentec. And they were talking about how like he probably was using AI to trade before it was what it has become, in the sense that like people kind of understand this. Do you think that in the future, every single hedge fund, every single asset manager out there is basically going to just have a large language model that is sort of like looking at all the different inputs, kind of like what you were talking about, but now just on this like bigger scale, and it's just all going to be AI trading, and like individuals are just not going to make trades? Like, I'm curious, what do you think that that's like a thing?
Well, no, I think it's a great point. I mean, when I started hearing like 10 years ago, like some of these pundits would be like, it's the machines, it's the algo's gone wild, like all that sort of stuff. A headline would come out and a stock would spike or a stock would do this. And I was actually really skeptical of it because the way I came up in the markets, all I knew was people making qualitative decisions about which way a stock was going to go. And I'd not been exposed to sort of quantitative trading. Now, when I worked in that derivatives group at Merrill Lynch, I worked with some really brilliant guys, and they were really focused on these quants that were in the back rooms, like working on some models, but it was really valuation. They would pump out these results, and then I think these guys would trade off of the results. You know what I mean? But it was that at that point they were making the decisions, and at some point, I think in the last 10 years, I think that has changed dramatically. You know what I mean? Like systematic trading has really sort of taken over. And I suspect you just mentioned all these names like Paul Tudor Jones and Ray Dalio and, George Soros. I don't know if you mentioned those guys, or Druckenmiller, all these guys. I mean, they were like these masters of the industry. And like, if they were like, gold's going higher, it would go higher. You know what I mean? If they were like, the internet bubble can go on for 2 more years. Well, it went on for 2 more years. And then they'd tell you like in April of 2000, they're out of their internet stocks. You know what I mean? All that sort of stuff. And I just don't believe that to be the case. Now, it could be that I'm somewhat removed from some of that stuff now. But the one thing I just say to the audience that listens to our podcast or watches Fast Money, I'd say that the odds are increasingly against you to be able to outperform some of the things that are going on in the market. And I'm not saying that people should not continue this endeavor if they're really interested in markets. But what I do say is that like everybody has hobbies and there's some cost to those hobbies. You know, Jen, you might like to kite surf and that might cost you, 30 grand a year to travel and to buy the equipment and this and that, whatever. Or you might, Kristen, like to whatever. You might like just to travel. That's your thing. Every quarter you go on this amazing yoga retreat and,
I really love this life that we're living in this hypothetical universe where I am a kite surfer and you are just bopping around the
traveling.
world.
Yeah, but I mean, listen, each one of those endeavors costs you money. It costs you like your valuable resource of time, all that and headspace and all that sort of stuff. And I guess the point I'm saying is if markets are your kink, like get after it, people. Like, you know what I mean? Like, enjoy the heck out of it, but just understand that, that experience that you have at kite surfing, you come back from Puerto Rico, it's over. You know what I mean? Like you might have learned something, had some fun, but it's gone.
Well, that's like the same thing with when people go to Vegas. It's like you should go to Vegas expecting that the price of admission is however much you're going to be putting down on the craps table or whatever game you're playing, because unless you are a professional poker player and like you actually are really good at it, like for the most part, that's the price of admission, which I also think to your point, I mean, actually getting in the markets, either trading or not, I mean, you can learn something from it. It can be an education. And by the way, you can also go to college and, spend $80,000 a year for that, but not the same education. So I do think, again, you're exactly right that if you look at it, that this is the cost of admission, it's the price of playing the game. You take a slightly different view if you lose a little bit of money. I mean, which
but I
I
think that's more geared towards trading. There's been this phenomenon. Obviously, it started with rotisserie baseball, and then fantasy football, and then those going online with DraftKings and FanDuel, and then a lot of gambling got legalized, and now there's in-game gambling. You know what I mean? Betting and this and whatever. And a lot of my friends ask, well, why don't you do that? And I'm like, that's what I do, like for a living. You know what I mean?
Well, I want to ask you this. We've debated this in a friendly way on this podcast. Do you think that all trading is gambling?
No, I don't. I mean, but again, I think it's kind of what Kristen said too, is like the cost of admission of going to Vegas is like every time I go to Vegas, I have a certain amount of money that I'm willing to lose, and I really don't want to keep hitting the ATM machine. You know what I mean? Because I know that if you're chasing that, it's just not going to end well. And so I think there's a degree of randomness about trading that does feel like it's gambling, right? And so we already talked about how some of the best traders make money 50% of the time. So it's the skill set of being able to manage, risk. And I will say this, I'm 8 years into, trading, investing. I still make some of the same mistakes that I made when I knew so much less, you know what I mean, about what I'm doing. And that's just human nature, and that's why casinos exist. That's why the house exists. That's why DraftKings exists. They know that people can't help themselves. It's addictive. You know what I mean? You always think that there's a turn coming, that sort of thing. And it's just hard. So if you're chasing, and I don't even play cards, by the way. I mean, I play blackjack and I don't play poker. You know what I mean? Like to me, it's like, that's how my mind works, like Monday through Friday, 8 a.m. to 5 p.m. I just don't need to do that in my off time.
Can I ask you a really nerdy question about something you said? You talked about the vol surface. What is the equity vol surface? Because in my mind, the vol surface is a fixed income native where you have expiries, right, from short to long, and then you have tails from short to long, right? And you have a nice little three-dimensional world with undulations there. But how do you have long tail? Like, what is your tail? Because the tails are the underlying rates.
Yeah, I mean, it's basically the same thing. You know what I mean? And there's different ways to kind of look at it, but that's a great example. Is like, so I was trading directionally. So just to give you a quick sense of like why I had a prop long short directional book in an equity derivatives group. So think about this. And this was in 06, 07. These hedge funds were becoming increasingly sophisticated about how to lever up. So we just talked about these firms needed to have PMs that were managing a lot more money. And how would you get leverage on their best ideas? Well, you could buy options. You know what I mean? So think about this. So when, let's say, going back to SAC, okay? SAC would go to Merrill Lynch and they'd say, where can I buy 100,000 of the October 110 calls, okay, in Microsoft? And the trader, the tech trader, the position trader would punch in a bunch of stuff. He'd get a vol surface, you know what I mean? Like you get all the pricing of the option, and he'd make almost purely a quantitative decision of the price where he would sell those options, or she, right? And so those folks are using all of those sorts of inputs, right? All those quantitative inputs, and looking at the vol surface, and looking at, this is another important point, looking at their existing positions, right? And how that would change the book of the underlying positions. And so that was very important. I had to learn about vol surfaces. I never, ever implemented it into anything I was doing. And one of the reasons this goes back to why I was there in this group is that these market makers or these position traders at these banks, if a smart hedge fund was going to come in and say they wanted to buy 100,000 calls in Microsoft, these guys and gals better start figuring out what would the reasons might be why a fund like that, who's a 13F, oh, they're like, a holder of 2 million shares. You can look at that, right? Why might they be looking at Microsoft to define their risk at a certain price at a certain point in time? What are the catalysts out there that would make those options be profitable? And so that was one of the things that I was meant to do, is kind of help think about what are the events, what are some of the inputs that a long short equity PM or trader might be thinking of. Does that kind of answer your question a little bit?
Yes. Yeah. And I think my other question, I think what I understand now, so the two kind of axes of the vol surface in equities are strike versus expiry. So you're looking at like the skew surface versus tail and expiry, because then in fixed income you have tail, expiry, and strike, right? So and then you have, are you in a log normal or a normal vol environment, because rates can go negative, which equities can't.
Well, my eyes just glazed over.
That was just like a fundamental question that I literally didn't know about the equity market when you said vol surface. I was like, but what do you have instead of tails? And it's strike, which never
well, and listen, one of the things when these people who run these books, when they are looking at pricing an option or pricing, in order, they never want to sell the tails, like as you know what I mean? So like it might be the best client in the world, unless you can hedge that out. But even when you're, hedging a tail, when things really blow up, it's not going to be good enough. You know what I'm saying? Like, so that was something I kind of remember the position traders doing this thing where they ran these reports. I can't remember how frequently, but it was really like cleaning up those kind of, some of those penny options or whatever, you don't want to stay short them, and you won't sell them if they're a nickel, but you definitely don't want to remain short them, if that makes some sense.
I think too, one of the things that's so interesting that has really been highlighted for me here is that you can think you're even would never call myself an options expert, but like somewhat dangerous in options. But the equity options world is a completely different universe than the fixed income options world. So just because you think you understand Greeks and you think you understand the basic mechanics and intuition, these are two totally different worlds with their own rules, with their own dangers. And you really need to immerse yourself in that environment before you can even think about doing anything other than paper trading.
Well, I want to say one other thing. I mean, look, I told this story a little bit to you, Dan, before we hit record. But when I started on the converts desk, converts, I mean, by definition, it is debt or a preferred that can be essentially converted into equity, or you have like mandatory converts, which are a whole other thing. And I remember when I started, I tend to think of myself as a smart person, as an engineer. I understood some of the basics of how these worked, but there was such a disconnect between the academic understanding and like payout profiles and then the intuition. You start to work with it. And I remember I started the first day, I was just writing down things. I felt like I was literally sitting on a desk and people were speaking a different language to me, right? With the like, it's trading at this spread and this implied vol and like all these different things. And then finally, probably a month into it, it clicked. And by the way, I understand how converts work. I understand how like call spread works, but then you started throwing out butterflies and stringles and straddles and all this stuff. And again, I know that if I wanted to like really internalize it, it would take essentially immersing myself in it. And I know you say you're not an expert in this. I was rolling my eyes when you said that because you clearly are, but it just takes this additional living and breathing it to really make it innate.
It's funny that you say that. If any of the folks who I worked with back in 2007, when I was just starting out, they were like, why is this guy so thick? He can't get some of these concepts. And part of it was, I was probably in my early to mid 30s, and I'd just been so conditioned in the business to doing things the way that I had learned. Now I evolved, but then when I had to get into like derivative theory, it felt like freaking homework. It felt like something that I was not that interested in doing. And so it actually took me a while to really get a lot of these concepts, because I knew it wasn't going to, it was like taking this Series 7. It's like a full day of testing on what you were going to probably use 6% of for like the next 10 years of your career. And I kind of felt that was the case. But until I had some command over this, these guys were like, listen, dude, you just keep trading the stocks until, you know what I mean? Like until you get some of these concepts down. One thing I wanted to say, because we spent some time talking about retail traders and what is a retail trader? Somebody who just kind of manages their own money and makes their own decisions, this or whatever. Robinhood reported like a week or two ago, and I was kind of floored. 50% of their revenue in that quarter came from options, which is amazing. What? Yes. So it's telling you, and one of the things that we've known for a while is that options, because there's so much that goes into the pricing, there's still a wide spread on most options. Okay. And there's still, so that means there's still margin in it. All right. Commissions are still reasonable relative to trade for free at your favorite, online broker. And there's no spread in stocks anymore. Most stocks that people are trading, you're basically, if you see the price at $100, you're going to pay $100 if you want to buy it, or you're going to sell it at $100 if you want to sell it. And that is a very different situation than when I started. Stocks were trading in eighths and quarters before they went decimal. There was always spreads. Now, if there's tremendous demand for a stock because there's news hitting the tape, the stock will just move. It's very fluid, right? The way it'll move. In the olden days, I just said it.
In the late 1900s.
In the late 90s and early 2000s, and I'm just going to call them the olden days, half the stocks traded on the New York Stock Exchange. Let's just say there was news out in JP Morgan. Let's say the stock was trading at 96, and there was like really good news that just hit the tape, or something like that. The specialist on the floor of New York Stock Exchange would maybe he'd spread the stock 98 to 104, this huge, like spread. And and they were, sorry again, ladies,
it's fine.
They were mostly had the ability to do that. And then you know what would happen? There'd be an order that came in by 25,000 at the market. Well, it was trading at 96. He just spread it 98 to 104. He might have that 25,000 trade at 101. He would sell them. Okay. And then some other market participants. So let's just say it's up $5. Okay. He sells the 25,000 at 101. He sure as shit is not going to lose money on that. And then there's a sell order that comes in at the market because someone just saw it trade from 96 to 101. And they're like, I want to sell at 101. And then that market order, he fills it. You ready for this? At 99. So he sold it at 101. He covers the short at 99, makes $2, and then you find an equilibrium. Then he starts tightening up the spread because you went 99, 101 when it first was 98, 104. And so all that's gone. I mean, like all of that is gone. You never see anything. So it was kind of in the olden days, ladies, it was like the wild, wild west. How's that?
I love that. Any final words of wisdom, whether related to career or finance or anything that you would leave our listeners with?
Yeah. I mean, listen, I'd say one thing, I talk to a lot of college age kids and they're always asking for advice. How did you get in? How did you maintain it? I think you have to be ready to pivot. When I think about myself and what the skill set you think you're learning at the time when you're most impressionable, it's likely to change, or the needed skill sets, you know what I mean, in that job that you're setting out to do. But you also have to be creating other skill sets that are going to be applicable to where this industry might go. We've given a lot of examples over the last hour, in our conversation about that. And so some of the folks who just cannot learn new things, you know what I mean, and cannot see where the business is going or how they might adapt to the changes, it's just, you're going to end up finding yourself out of a seat. That is just a sad commentary, because we talk about technology also. Efficiencies are coming, you know what I mean? So think about the investment that a lot of these companies are, you saw that JP Morgan just launched a customer service bot. Well, you could go back and use that example of, when ATMs, automatic teller machines came in, everyone said the bank teller is going to be put out of business. Well, yeah, they did find other uses for them. They could start underwriting loans and, you know what I mean? Whether they be auto and mortgages and this, and whatever. Great, but this might be the transformative technology, like to your guys' point that you made before, that makes human, processing power that much like less interesting for a whole host of different industries. So figure out these technologies, how they're going to impact your industry, and be able to continue to adapt, I guess, is the one thing I'd say.
And Dan, I'd love it if we could just quickly list out, I know Kristen touched on it earlier, but there's so many different places to listen to you and to the knowledge that you have to share. And I like to think of our podcast as the 101 primer that you need to fully appreciate the content that you put out. I think without a crash course in the fundamentals, so much of what you share is potentially lost on people. But once you've listened to the Wall Street Skinny, you obviously are well equipped to listen to all of the content that you guys put out. So we've got, just to run down the list, so we've got Fast Money on CNBC. And then what are all of the shows that you put out through Risk Reversal Media?
That's great. And by the way, I'm going to say this really quickly. You guys are 100% like the great place to start for any of these conversations, because without that framework, it's like a lot of this stuff, again, goes right over people's heads. So I really appreciate it.
Well, then you feel scared by it or intimidated by it. Whereas, again, even I understand your content better from what I've learned from Kristen in just the past 18 months that we've been doing this.
Well, listen, you guys have also made it really fun. I mean, that's the other thing. You would not have the following you have and the engagement that you have. And, Guy and I, we listen, we're old guys. You know what I mean? Like we're never going to do the reels and the TikToks and all this stuff. You guys are so good at it. And by the way, it was Ron Biscardi and Caitlin Balin from iConnections who turned us on to you guys. And they're like, these guys are doing something that no one else in financial media is doing. And iConnections is a great partner of ours. So we really appreciated that heads up by them. So what we're doing, so we have On the Tape podcast. We started it 4 years ago. Danny Moses, you might know him from The Big Short. He is our co-host, and that drops on Fridays. And it's usually the first half is the three of us talking about what's gone on in the markets and giving in some views. The second half, you guys were a second part of one of them, but oftentimes we'll have a market strategist or an investor, and we'll get their point of view, which hopefully is a lot different than ours. We also have another edition of On the Tape with Liz Young-Thomas, who is the head market strategist at SoFi, and Guy, Liz, and I do a look ahead. So that's on Mondays. And then we do Market Call Tuesday, Wednesday, Thursday, which is a live streaming on our YouTube page, Risk Reversal Media, that we do with Liz one day and Carter Braxton Worth of Worth Charting. And he is a technical analyst. That's all he cares about. And so we do that. And then we have OK Computer, which is a tech podcast that I host. And we have a lot of great tech investors, both public and private, and then some operators that come on that. And then Market Matrix, which you gave me a nice little shout out on. So, and that drops every Monday, Tuesday, Wednesday, Thursday, Friday, right after the market close. And that's under 10 minutes, 10 top stories, not read by Guy and me. Don't worry. By that point, you're probably sick of hearing from us. So.
Well, and I will also say that if anyone's a classic rock fan or a Pearl Jam fan, you should definitely listen to these podcasts, because there's always a good quote or a good reference or a good trivia about one of certainly my favorite bands. How many Pearl Jam concerts have you been to now, Dan?
I've been to probably 25, but this month is going to be epic. I'm going August 31st to Chicago. I'm going September 3rd and 4th to Madison Square Garden here in New York. I'm going to September 7th in Philadelphia, and then I'm going September 15th in Boston at Fenway. And in between that, I'm going to see a couple other things. The Killers here in New York. So,
that'll be so good.
But listen, ladies, that's empty nesting, and you only have a few years left to that. So,
oh no, my youngest is 2, so I've got a while.
I got.
Yeah. But no, thank you so much. This has been amazing. And so we will link in the show notes all the places that our listeners can find you. And again, thank you so much, Dan. This was amazing. And we will talk to you again very soon. So
and we're going to see you at iConnections in January.
Yeah. I can't wait for that. That's going to be Global Alts, late January. We're going to kill it. And the other thing is, I hope you ladies will come back on our podcast, because we had
anytime.
Next time you're in New York City, let us know, and we'll sit down in our studio. Can't wait.